Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to do an analysis on the company Fortinet. Now this company was actually brought to you by Stefan. It has been 7 days since you commented this. I am so sorry, but there's just been a lot of companies that people have been recommending and I've been trying to get through them the best as I can, but finally got to yours, my dude, and he pretty much just said, we'd love to see an analysis of Fortinet FTNT. Congratulations to 1,000 subscribers. Thank you so much. And yeah guys, recently reached 1,000 subscribers, so if you guys like this kind of content, please make sure to hit that like, subscribe, and of course comment. All helps here with the algorithm on YouTube. So yeah, let's actually analyze this company guys, Fortinet, which they are a cybersecurity company. This would be fairly interesting, especially seeing that we have been getting hit with a lot more cyber attacks recently in the past 2 years. So with that said, let's get started with this analysis. We are going to start off guys coming into the calculator. This company does not pay out a dividend, and that actually might not be too bad of an idea because when the company doesn't pay out the dividend guys, this means that they could just reinvest all of their cash back into themselves in the form of buying back shares, which by default raises the value of the shares that you already own. Ticker symbol of FTNT, market cap of $41 billion with a PE of 63.61. That's a lot guys. That's a whole lot. So if I want this to buy this thing 20 or under with the current share price of $51.87, this is telling me that it needs to fall a significant amount. So yeah, it is what it is. Now as I said, they don't pay out a dividend, so as you can see looking at these average 5-year free cash flows and last year's free cash flow, by the looks of it, it is looking like it is increasing from the 5-year average to last year. So we'll take a look at this further into the fundamental analysis. So let's actually come now into the fundamentals guys, starting of course with the net income. We got 5 years ago of $31.4 million to 1 year ago of $606.8 million. That is a massive increase of 1,832%. Now let's actually take a look at this graph because this is actually fairly interesting. We see that from 5 years ago to 4 years ago, massive jump from 31.4 to 335 million. Then they came down 3 years ago to 331.7, and then 2 years ago when COVID hit, they just spiked. They skyrocketed up to $488.5 million, and then the following year they still did pretty decently at 606. So as you can see, it is somewhat staircasing from the 3-year point to the 1-year point, but we do have a couple of outliers here, like this massive jump that we just saw right here, as well as this drop over here. But overall, it's actually not looking too shabby. We'll see what today's value is, because once today's value comes in, this one will essentially disappear, and then we would only have just a 4-year ago to the 3-year ago value. Only one of them should be down, assuming that this year is higher than $606.8 million. So for that guys, I'm actually going to give it guys of a grade of like 75%. It is looking okay, but you know, they did have a massive jump, as well as they did do a little bit of a decrease right here. So that's essentially why I'm giving it a 75%. Coming down to the free cash flow, the most important of all the profit metrics, because guys, this is the one that companies use to essentially pay out everything, absolutely everything. Buy back shares, pay down debts, issue a dividend, make acquisitions, and overall just grow the company. Very, very important to actually have this thing, first of all, be positive and be consistently increasing. And yeah, this is actually looking fairly interesting. 5 years ago of $459.1 million to 1 year ago of $1.2 billion, increase of 162%, with a 5-year average of $784.5 million. We saw this at the beginning of the spreadsheet. Guys, take a look at this graph. Oh my god. Like, Stefan, okay, this is so far just the free cash flow, but this is absolute perfection right here. Wow. Every single year, staircasing perfectly. There doesn't seem to be like an outlier year like we have like here, where massive jump from 5 years ago to 4 years ago, right? Everything looks essentially perfect. It's staircasing year over year, it's increasing year over year. For that reason, guys, I have to give that 100%, and it's usually very rare for me to give a 100% free cash flow, because usually there's like 1 year that it just didn't go up as much as before, or it slightly went down a little bit. This is absolute perfection over here. And now when it comes to the revenue, well, we get pretty much the exact same thing as the free cash flow. perfection as well. We got 5 years ago of 1.5 billion to 1 year ago of 3.3 billion, increase of 123.57%. And just as I said, guys, every single year consistently increasing. Overall, again, 100%. Wow, just based off of these profit metrics, guys, you know what? Net income, I gave it a 75%. I guess you could argue it could be a little bit higher to like 85 maybe, but I'm going to stick with 75. Cash flow and revenue, mwah, perfection, absolute perfection, because this is just exactly what you want to see. Nice consistent increases, no outliers, and the reason is because the more consistent something is, the more of a realistic prediction you can actually make. If you see a company that is consistently growing like this, you could pretty much just say, okay, then next year they'll probably be at around like 3.6 billion dollars, and the chances of that happening is higher due to the fact that it is fairly consistent, as opposed to if they have like flat, spike, and then flat. So it's actually really good to see that out of the 3 profit metrics, 2 of them are 100%, and one of them, being the free cash flow, the most important, is also at a 100%. So very good to see. Now coming to the assets and liabilities. Well, unfortunately, this is where the niceness stops. It's really sad to see, but as you can see right here, they currently, guys, cannot cover their liabilities with their assets, which means that if things really were to hit the fan, they might actually go bankrupt. As of this year, they're at negative $380 million. Now, to their credit, I guess you could say within the past 5 years, they have been positive, and only this year is when they actually went negative. So let's actually take a look at this further into right over here, the total assets and the total liabilities. What actually came down and what actually went up? Well, looking at the assets, we see 2.25, 3, 3.84, 5.9, and then 5.3. And then at the liabilities, we see 1.6, 2, 2.5, 3, 5, 5.6. So you do see the fact that the assets have come down a little bit, and also the fact that the liabilities have gone up as well, which is kind of the reason why as to why this thing actually went negative. So it's unfortunate, but they are taking on more liabilities as it currently stands, making this negative. So unfortunately, I cannot give this a pretty good grade, just like I did with the profit metric. We get the average assets at 4.1 billion, average liabilities is 3.4 billion, and doing this difference, we get $702.8 million. So unfortunately, guys, I cannot give this thing a really good grade because they're currently at a negative number. I'm terribly sorry. So for that reason, I have to give it like a 45% because it's just this negative $380 million is really concerning. I guess you could make the case of like 55 or so, right? Because, okay, they have had 5 years of positive, which is good, but this negative one's really bothering me. I'm gonna keep it at 55, but just letting you know, I'm more comfortable with like 45. Now looking at the cash flow minus the liabilities. Let's see if the cash flow can actually cover their liabilities because, well, the cash flow has been perfect. It has been consistently increasing. However, the liabilities have also been consistently increasing as well. And what we're mainly looking here, guys, it is essentially, are they at least getting closer and closer to zero? Is their cash flow getting to the point that it is able to cover their liabilities? Now, as you guys can see by this graph, it is looking not good at all. Currently, as of 1 year ago, they're at negative $4 billion in this difference. And beyond that, guys, looking at 5, 4, 3, and 2 years ago, it is just getting, it is pretty much staircasing downward, further and further into the negative. That is not something that you want to see because on top of the assets not being able to cover their liabilities today, the cash flow can't cover their liabilities either. And it's not looking like they are getting closer and closer to zero. So that's not good at all. Average cash flow minus the average liabilities, we get around $2.1 billion. Guys, I'm sorry, but I have to give this essentially a 0 because there has been one single year that they just increased it slightly above the previous year. Every single year is getting further and further into the negatives to the point that as of this year, they're at their lowest at almost $4 billion. Looking now at the shares outstanding, the most underrated of all the profit metrics, because this is the one that companies issue. And well, this one dilutes you guys as the investor. So it's not something that you want it to happen to you. You want the company to be buying back shares. Now, this company does not pay out a dividend. So really, you would expect them to be issuing shares. Normally, companies that don't pay out a dividend issue shares because they're like, we don't have to pay out a dividend. We don't really care. It doesn't hurt us at all, right? But it's actually fairly surprising here. In this one, they are buying back shares. 5 years ago of 839.5 million shares to today of 788.4 million shares. That is a decrease on the 5-year of 6.1%. Fairly good. It's more than 5%, which is something that I like to see. And from the previous year to the current year, so again, 1 year ago to today, they bought back 2.67%, which is actually massive. Normally it's like less than a percent. That's actually a really good decrease, guys. Now, looking at this graph further, we can see that not always did they buy back shares. From 5 to 3 years ago, they actually issued going from 839.5 to 858.5. And then after 3 years ago, during COVID, is when they actually started buying back shares, probably because they realized our share price is so cheap, let us just start buying back shares. I think that's the reason why they did it. I mean, it is a perfectly understandable reason as to why, but because of the fact that from 5 to 3 years ago, they were actually issuing and then they started buying back, overall in the 5-year, it is decreasing. I'm going to give it above a 70, but I cannot ignore these three values over here, guys. So for that reason, I'm going to give it like an 80%. And now looking at the cash and equivalents, they currently hold $710 million with an average of $1 billion. So doing a quick overview on all of their fundamentals, we got the net income 75%, pretty decent. You could argue that it would be like an 85%, but I gave it a 75%. Free cash flow, revenue, guys, perfection. It was just beautiful in every single direction. It's consistently increasing year over year, no outliers. It was just perfection. I love this. And actually, these two metrics brought this whole entire grade up, as you can clearly see down here. Average assets minus the average liabilities, 55%. Guys, that negative value today is really scaring me. Even though they had the past 4 years of positive assets and liabilities, I cannot ignore that current year. So that's essentially why I gave it a 55%. Cash flow minus liabilities, even though their cash flow is perfect, their liabilities is just getting further and further in the red. I have to give it a 0. And the shares outstanding is doing pretty okay at 80% for an overall grade, guys, of 78%. Not too shabby. The main issue here, guys, is honestly the liabilities. If they were to just fix the liabilities, this would be like 90% instantly, right? This would be a 90% company for me, which is actually very rare to see. So now with that said, let's actually figure out if at the current share price, it is actually a decent buy using discounted free cash flow. So now let's come over here to the discounted free cash flow and make some assumptions, low, median, high, using of course revenue growth, the predicted share buyback, and the required rate of return, which I like to keep it at 10% across all assumptions. So coming over here to seeking alpha, we can see that the revenue growth forward is a whopping 27.13%, and the revenue growth year over year, it is 31.1%. Guys, is this going to continue into the future? I don't know. Right, I really don't know. But just as a basis, we're already seeing that not adjusting for debt is $23.66, and adjusting for debt, it comes up to $48. So any number that we put here in the positives, I mean, even at like 10%, this is probably going to bring it up above $51, especially after the predicted share buyback. So for the revenue growth for the low one, let's actually say 10%. Why not? For the medium one, let's go with 12%, and for the highest one, guys, let us go with like 14%. For the predicted share buyback, they have done 6%, but they have issued as well. If the share price goes down, they'll probably be buying back more shares because it is at a cheaper price. So let's just assume that based on what happened today with the current market collapse, which by the way, if you guys haven't seen, FTNT did fall 7.11% today. Massive red day after CPI. I just did a live stream. If you guys want to check out that VOD, make sure to check it out. CPI, guys, came in at 8.3%, which just completely tanked all the markets. Here is the NASDAQ, which FTNT is under. So you can see down 5.16%. So if this continues to fall and FTNT does continue to fall, they'll probably be buying back a lot more shares. At 6%, I don't necessarily know, but 6% actually isn't a whole lot. So let's just say for the low assumption that they'll do 4%. For the median, let's say 6%, and for the highest one, let's say 8% share buyback. With that said, guys, we do get some target share prices, not adjusting for debt, of $34.80. Median is $37.95, and the highest of $41.34. Adjusting for debt, This is why we take a look at the cash and equivalents, and we also add the net debt when putting in all these numbers to get the discounted free cash flow. Because if a company has more cash than debt, then the value comes up, and if the company has more debt than cash, then the value comes down. So you can see it does come up, guys, by a significant amount. What is that, $36 or so? Yeah, it comes up to $70.55 for the low assumption, $76.85 for the median, and $83.65 for the highest assumption. Adding a margin of safety of 5, 10, and 15%. This puts me between $60 to $67 for the low assumption. For the median, it is $65.32 to $73.01. And for the highest one, it is $71 to $79.50. Guys, the current share price is $51.87. So this tells us a whole lot, that basically for the target share prices, not adjusting for debt, you would still have to wait. But adjusting for debt, well, we are pretty much there, right? We are, every single value here, it is higher than the current one, so it's looking like a pretty good value to buy it at. And in fact, with the lowest assumption, assuming that the company will grow at 10% and do a 4 projected share buyback, guys, the 15% margin of safety, it is $60. We're at $51.87. This is looking like a really, really good company to buy, even at the lowest assumption. So it is what it is. I personally think that the fundamentals of this company are pretty good. I mean, I did give it that grade that you guys saw. So based off of my assumptions, this is looking like a fairly good company if you want to buy it for like a growth perspective. The fundamentals are there. Their free cash flow is increasing. The main issue is those liabilities. But just because my assumptions tell me that this is a good buy based off of the after debt target share price doesn't mean that you guys may think the same, right? Every investment is the present value of all future cash flow, and this is not financial advice. So please have these calculators. I have this one, the book value one, the reevaluation one, and a dividend tracking sheet for everybody to have. This company doesn't pay the dividend, but if you guys have dividend companies and if you want to set up like a dividend portfolio and like a Roth IRA or whatever, you guys can have this tracking sheet, so that way you don't have to be logging into your brokerage every single time. And on top of that, I also have this one as well, which is part of the dividend tracking sheet, where you guys can see how much in dividends you would get per company per month, and not only that, on a quarterly basis and even a yearly basis as well. So it's actually pretty cool. Again, I'm giving this out all for free, guys. All I'm asking for in return is just help me grow my channel, like, subscribe, comment. Really does help it with the algorithm on YouTube. Thank you so much for the 1,000+ subscribers. I really do appreciate it, everybody. I really do. I just did a live stream. Though I didn't announce it, I just forgot. I am so terribly sorry. I forgot. I came home and I'm like, oh, that's right, I have to do a live stream today. It's CPI day. Whoops, sorry. Next month I will probably do it a lot better, like in advance. I'll say it like a week in advance, and I might even try to bring somebody along with me, just so that way we can have some interaction talking to each other, right? So yeah, you guys get free content, free calculators, a dividend tracking sheet, live streams. All I'm asking for, guys, is just help me grow my channel, like, subscribe, comment. It really does help. And please come up with your own assumptions, because again, not financial advice. I want you guys to see, hey, I disagree with you on this. I don't think this company will grow at 10%. I think they'll grow at like 5% for the lowest assumption, right? Well, that pretty much changes the target share prices after debt, right? So it really just depends up to what you believe this company will do in the future. All in all, when it comes to FTNT, you know what? I gotta say, not too bad. And by that, I mean it is actually amazing, especially when it comes to that free cash flow. Guys, this is absolute gorgeous. These profit metrics are just, oh my God, this is like Apple level kind of profit metrics right here. This is kind of like mega cap Apple, Microsoft profit metrics. They are really good. The main issue that I have is just these liabilities, man. These liabilities are just really bad. But yeah, really good of a company, not gonna lie. Stefan, thanks, man. Thanks for telling me about this, because this is actually a banger of a company. I'm personally not going to buy it right now, mainly because I'm not buying any stocks right now, but this would definitely fit into like a growth portfolio, if anything. So hopefully this helps anybody who's looking for like a growth related company that was, I guess, on the cheap side. I mean, according to my assumptions, it is a pretty good buy right now. Anyways, that pretty much is it for this video. Like, if you like, comment, subscribe. It really does help it with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.